Have you ever looked at a stack of important papers, maybe old bank statements or payment stubs, and wondered just how long you need to hold on to them? It is a common question, especially when it comes to your tax records, and knowing the answer can save you a lot of worry and clutter. When it comes to keeping tax receipts, the simple answer is no. You do not always need to keep them for 7 years. While 7 years is a common recommendation for some specific situations, the general rule of thumb for most taxpayers is usually 3 years. The reason for this depends on a very important timeline established by the Internal Revenue Service, known as the Statute of Limitations. This period defines how long the IRS has to audit your return, assess additional tax, or how long you have to claim a refund. For most returns, this period is 3 years from the date you filed your original return or the due date of the return, whichever is later. This means that after 3 years, the IRS generally cannot question the accuracy of your tax return. However, there are important exceptions to this general rule that you absolutely need to be aware of. For example, if you do not report income that amounts to more than 25% of your gross income, the statute of limitations extends to 6 years. If you file a fraudulent return, there is no limit at all, and the IRS can assess tax at any time. A key situation where the 7-year period comes into play is if you claim a loss from worthless securities or a bad debt deduction. For employment tax records, the recommendation is for years after the tax becomes due or is paid, whichever is later. And if you never filed a return, the statute of limitations never even begins. To make sure you are keeping your records correctly, it is wise to organize your documents by tax year, keeping all related receipts, W-2 forms, and bank statements together. Consider digital copies as a backup. Many apps and services allow you to scan and store receipts securely. This can be especially helpful for proof of expenses for deductions like medical costs, education, or business expenses. Think about major life events too. Records related to buying or selling a home, investments, or retirement accounts should often be kept longer, sometimes indefinitely, because they affect the basis of assets you might sell in the future. Understanding these varying timeframes empowers you to manage your financial documents with confidence, ensuring you are prepared for any future inquiries from the tax authorities while also helping you avoid unnecessary clutter. By knowing these guidelines, you can keep what you need, discard what you do not, and enjoy greater peace of mind with your financial organization.